Hey, good afternoon, ladies and gentlemen. Welcome back to our weekly market review. This is 2nd October already, and we are into the final quarter of this year. Gerald, any holiday plans yet?
Well, so good question because I was just booking my flights last night and then I realized that the air ticket prices have gone up by so much compared to what I was thinking of at the same time last year.
Wow, so I think the travel demand is still not subsiding yet, since the prices are still at somewhere near the peak or even slightly higher. So anything that the Santa Claus rally can help us subsidize some of this increase in cost on our transport, our water, and I believe our oil price, the petrol price is the next one that's going to come.
Well, it still seems like quite a number of moving parts for the entire market. Just last week alone, we saw oil prices spiking up once again. So that is trying to cause further inflation concerns. So I'll go through some of this in the weekly market review this week in terms of what could drive the market going forward.
Okay,
Okay,
I think
so
Jeff, take it away, man. Help us understand the market more and then see what we can do to help us offset all these rising costs.
sure, I'll try my best. Okay, but before we do that, just a word of disclaimer that today's session is really for education and information purposes, as we all try to learn how we can make our money work harder and be able to cope with inflation. But it should not be taken to be financial advice in any way. If you find the session helpful, do leave a review on Google by scanning this QR code or going to the URL that is shown. And if you would like to join SIAS as a member, the membership fees is just $1 per month or $12 per year. So it's always good to think that this is something that is less than a cup of kopi C or your kopi on a daily basis. And if you want to be joining SIAS as a member, you can scan the QR code that is here. Okay, so what did we see for the market in the past week? It is the last week of September. The US markets closed mixed after a very weak month of September, where we saw the US market coming down by quite a bit. But the positive news for us in Singapore is that the STI actually outperformed with a 0.4% increase compared to the previous week. Okay, we'll dig deeper to see what are some of the top gainers and losers later, as well as what are some of the key stocks that are moving within the Singapore market. But the news that really impacted the market was the very sharp spike in oil prices. At some point in time last week, we saw oil actually bouncing back to above $95 per barrel. And that actually represents the highest level in 2023. So given that a lot of the moderation in inflation is driven by this fall in oil prices that we saw in the first half of this year, this spike in oil prices that we see is once again driving a lot of inflation concerns, as well as the expectation that central banks globally will have to keep the interest rates at fairly high levels to be able to bring down inflation. So what is driving this increase in oil prices? Okay, so as always, we look at the demand and the supply. We'll look at the supply growth here first. So we are looking at fairly muted supply growth in 2023 of 1.5 million barrels per day. And more importantly, what actually caused the sharp spike in oil prices in the past few weeks was after Russia and Saudi Arabia announced that they would extend the production cuts through the end of this year. Okay, so supply growth is very limited. You don't see much new additional oil coming into the market, but demand growth is still continuing. So demand is expected to grow at 2.2 million barrels per day this year. This is driven by the fact that the global economy has been more resilient than expected. And if you think about this year compared to the previous year, we had the Chinese economy actually reopening. So while the Chinese economy is not actually as strong as what investors were expecting, but on a year-on-year basis, it is still driving the incremental oil demand growth. So when your oil demand is growing faster than your supply, that would naturally lead to an increase in the oil prices. Okay, so that is really the macro backdrop that we see. Oil prices at elevated levels, the interest rates continue to move up, the US dollar continue to be strong. So this is what we see being translated to the Singapore market as well. Earlier, I mentioned that the STI outperformed the US indices. And what we see here is that the gainers are led by Hong Kong Land, up 3.5%, Thai Beverage up 2.7%, ST Engineering up 2.1%, OCBC 1.6%, and Wilmar 1.4%. So once again, are there any similarities in terms of the top gainers? We see that some of these are seen to be beneficiaries of a strong US dollar. Hong Kong Land being traded in US dollar would be one of them. ST Engineering with a sizable portion of its order book in US dollar and potentially benefiting from a strong US dollar that then translates to their Singapore dollar reported profit. Okay, we also have the banks doing fairly well. So OCBC being one of the top gainers. When I checked the list last night, DBS would be one of the stocks that did relatively well last week as well. So effectively, banks would be seen as beneficiaries of a higher interest rate environment because they can potentially get a higher net interest margin. And that is what we see for OCBC share price in the past week. Okay, we go to the top losers. We have got Emperador, which is down 1.9%, SIA 2.3%, Yangtze Shipbuilding 3.5%, Frasers Logistics and Commercial Trust 3.6%, and last but not least, Venture Corp 5.4%. So we see that the REITs continue to be underperforming as the 10-year interest rate continue to go up. There are concerns about the lending or some of these REITs as to whether they will incur higher financing costs that will impact their distributions. Also, as the yield on the 10-year government bond goes up, it will make a relatively risk-free asset like the government bond appear more attractive compared to some of these more risky assets such as the REITs. So we see that the REITs continue to be very volatile in terms of their share price performance. Venture Corp is another name that has been fairly weak, reaching a multi-year low in the past week, and it's a name that we will discuss a bit more later on. Okay, so key movers, I mentioned that Venture Corp actually fell quite sharply in the past week. This really due to concerns about its exposure to the electronic sector. We've got actually one of the REITs, OE Commercial REIT, actually gaining 7% in the past week, and this after it rebounded from a one-year low. We have been talking about the oil price, and some of you may be wondering which are some of the names that can potentially benefit. So we saw the PTT EP SDR actually gaining 1.7% in the past week. Okay, so we'll start with Venture Corp. We saw that the share price actually came down to a multi-year low, and that is because of the continued weakness in Singapore's exports. So what we see here is that the Singapore non-oil domestic exports have been down for 11 consecutive months as a reflection of the weak global economy, and that is leading to concerns about some of the electronic manufacturing companies such as Venture Corp. Okay, so we see that being reflected in Venture's earnings as well. If you look at it in the first half of 2023, the revenue actually came down compared to the first half of 2022. And if you were to look at the net profit, it also came down to about 140 million compared to 175 million in the first half of last year. So overall, the weak electronic exports has actually translated into weakness in Venture's revenue as well as net profit. Okay, but some of the investors who are looking at Venture from a dividend perspective I've noticed that it is one of the stocks that has consistently maintained or increased its dividends. So if you look at it, even during COVID in FY20, they increased the total dividend per share to 75 cents. And that is a level that has been maintained from FY20 to FY22. If you look at the first half of this fiscal year, even though the profit came down, they actually maintained the dividend per share at 25 cents. Okay, so one of the reasons that investors might actually take notice of venture is really because of the fact that they have been paying a steady, if not increasing, dividend per share. Okay, so this is really the share price chart of venture. It has been fairly weak so far this year, reaching a high of about $19. But since then, it has consistently fallen to now $12.37 per share, which is actually a multi-year low for the stock. Okay, next we have OE Commercial REIT. For investors who might not be familiar with this REIT, the stock ticker is TSOU. Effectively, it has exposure towards three key segments: office, retail, as well as hospitality. So office would be its greatest exposure. We see that it has some of the renowned office buildings in Singapore, such as OE Downtown and OE Bayfront, as well as One Raffles Place. Okay, but apart from that, it has got exposure to the hospitality segment as well, including Hilton Singapore Orchard Hotel. Okay, so what is driving the weakness in OE Commercial REIT share price? That is really because of concerns about the exposure to the office segment, given the higher interest rate environment, as well as the slowing economic backdrop, as to whether some of these tenants would be able to keep their leases. And that has also translated to weaker distributions for OE Commercial REIT as well. We also see that the REIT has been impacted by some of the weaker foreign currency impact because of the overseas assets that it has. So if you look at the first half distributions, it is down slightly compared to the first half of 2022. Okay, so if you were to look at the share price of OE Commercial REIT, we saw that as the 10-year bond yield went up around the period of July, August, and September, it actually corrected very significantly to reach a low of about 20 cents per share. And then we saw that maybe because investors took notice of the distributions it was offering, we saw a rebound in the share price over the past 2 weeks to reach about 23 cents now. Okay, and earlier we spoke about the bounce in the oil prices. So investors have been asking what are some of the names that can potentially be exposed to higher oil prices. Wanted to talk about PTT Exploration and Production Company that trades in Singapore under a Singapore Depository Receipt, and you can find the stock code TPED. So what we see here is that the average selling price that it is able to earn is actually linked to the oil price because it is an oil and gas exploration and production company. So if the oil prices go up, it will typically be able to earn a higher average selling price for the oil that it is producing. So this is what we saw in 2022 when the oil prices were higher. The average selling price was at $53 per barrel of energy. And if I were to compare that with the average cost of production, the unit cost was about $28 per barrel of energy. So effectively, the difference would be a profit that PTTEP would be able to make. What we see in the first half of this year is that with the lower oil prices, the average selling price came down. But the hope that some investors might have is that if oil prices continue to recover, then you'll be able to get a higher average selling price for the oil it is producing once again. So the other thing to look out for PTTEP is that with higher oil prices, it is also aiming to be producing more oil. So if you look at the target that it has for oil production over the next few years, it is actually expected to grow by more than 5% per year. So if oil prices continue to go up, and if it is able to produce more oil, then that is something that will be seen to be positive for the company. Okay, I know a lot of investors look out for dividends. So the other thing that investors might look out for PTTEP is that it actually has a policy to pay out at least 30% of its operating profit to be able to give out as dividends to shareholders. So what we see here is that if you look at the dividends per share, it actually was 9.25 Thai baht in 2022 because of the stronger profit that it made last year with the higher oil price. In the first half of 2023, it actually maintained its interim dividend at 425 Thai baht. Okay, so this is what we see for the share price chart of PTTEP. It was listed for the Singapore Depository Receipt in late May. And if you look at the share price now, it is higher than where it was when it was listed because of the bounce in oil prices that we saw over this period of time. So the stock code is TPED for investors who want to do further work on this company to see how it can potentially benefit from the higher oil price environment. Okay, so what are we looking out in the week ahead? Tomorrow we have a corporate connect with Takra Crop. This is organized by SIAS, so do take a look at it if it's something that you want to discover small and mid-cap names within the Singapore market. Next, we have got the US non-farm payroll data coming out this Friday, where we'll be looking out for signs of the employment landscape in the US market to understand what might be the Federal Reserve's next interest rate move. So we are in a new month, new quarter, continued focus on inflation data as well as what the Fed is going to do. And that will probably be the landscape that we'll continue to look out for until the end of this year. So with that, I'll hand over to Sunny, who will share what does this actually mean for us when we are looking at it from a technical analysis perspective.
Okay, thanks, Gerald. So speaking about non-farm payroll and then the what will the Fed do with this latest data that we will have on Friday, I just want to highlight here before I go on to the charts, right? Actually, the Fed Watch 2 actually has a big change in the probability of whether we would see an unchanged scenario or even a rate hike. So the unchanged scenario probability dropped from 29th September, which is last Friday, a probability of 81%. We see that probably now drops to 63%. So a very drastic change over here, or when we cross over from September to October. And the chances of us having a rate hike, a 25 basis point hike in November, is now at 36% compared to the September reading of 18%. So it's like more than double what is the probability of September. So do look out for the CME Fed Watch 2 closely on the probability of the Fed rate hike, whether it will happen or not. So I just want to highlight this, that there are big of a there's a chance, there's now a very sort of an increased probability that there might be a rate hike coming. So we might want to monitor this closely. Okay, so going on to the charts, I'll touch on the STI first because the China market is on holiday. So the STI index actually, like what Gerald said, arrested the fall of the previous week. So last week we actually saw that the STI index actually outperformed some of the other major US index with a very slight gain for the week, 0.3 or 0.4%. So this is what you observe over here. So that more or less subside the fear that we saw the previous week before last week, where we saw a 2.3% slide. So nonetheless, previously we are talking about the resistance level, which is the shoulder level at the head and shoulder pattern. The immediate resistance we are still looking at is around this area, which is about 3,279 points. And the support we are looking at the low of May, which is around the 3,155 points. So this is still the range that I'm looking at, and where we are right now is about right smack in the middle, the STI between these two resistance and support level. And it's also caught in the tangle between the moving averages, whether it's the 20, 50 or the 200 days moving average. So I think STI is also waiting for some kind of direction, and that catalyst may come from this Friday non-farm payroll data. So the MACD indicator, although slightly negative, but then the dimension of it or the trajectory of it is not very great. So there's not much of a big momentum kind of observation over here for the MACD. So probably it will still trend between on this pivot of between the support and resistance level, which is around the 3,220 points level. That's the pivot level that we are looking at, where all the moving average are converging. On the RSI, also pretty clear. You can see that the RSI is now reading at 50. It's also a pinpoint at the 50-point neutral mark on the RSI indicator. The 14 days average of the RSI is also at 49.4. So all the indicators are telling us that the index now is pretty neutral right now. There's no big momentum observed in the index. And then between the support and resistance level, we are right smack in the middle at the pivot point right now. So not much of a movement expected for the STI index until at least later part of the week, where we get a clearer direction of where the US job data is. So on the Hang Seng Index, today Hang Seng Index is closed because of National Day holiday. And of course, China is also on the National Day holiday, and they are closed for 1 week, which is known as the China Golden Week. So we have been talking about the Hang Seng Index using this as a support level, the 17,587 point level. So seeing the big jump on last Friday on the Hang Seng Index further confirms that this is the near-term bottom that we are looking at. However, the jump that on Friday that you saw was actually capped at the green color line here, which is the 20 days EMA. And of course, slightly that is the 20 days of moving average as well. So we are capped below the 20 days moving average, which is still not a positive sign that we will see a rebound to retest the recent high of around the August period at the 20,000 level. So if you look at the trajectory of all the moving average, it's still pointing downwards. So the downtrend, the primary downtrend that we observed since the beginning of the year is still pretty strong. So the bounce that we see now, or last Friday, or even in the coming few days, might actually be a counter trend move. So this is still kept by the various moving average resistance level that you see over here. Okay, so the MACD is below the zero baseline and still reading negative, although we saw a bit of a converging of the MACD line towards the signal line on last Friday, a jump. But the overall observation of the MACD is still negative and below the zero baseline. Hence, the converging of the MACD towards the signal line, the momentum is still pretty weak. Okay, so a weak momentum here on the rebound as of last Friday. So we are waiting for more indication to see whether we could have a crossover of the MACD line above the signal line to give us further affirmation that this bounce that we see on Friday is likely to hold on and gain further strength. The RSI is also still below the 50-point neutral mark, reading at 45 last Friday. So it's a reading below 50 shows that the momentum is still weak right now. So this more or less confirm what the MACD indicator is telling us, and also what the moving averages are telling us. So all the indicators on the Hang Seng Index, I would say, are aligned together to tell us that it's still looking weak on the Hang Seng Index, even though we saw a 2.5% jump on Friday, and there are still quite a bit of a resistance level to watch out for on the different moving averages. Okay, so that is my take on the Hang Seng Index, and of course, the Hang Seng Index will also not be able to get a lead from the Chinese market as well, or from Shanghai or the Shenzhen Composite, because China is on holiday. So I think it will be a pretty muted week for the Hang Seng Index as well. So the focus now then will be on the US indices. So the Dow Jones Index, as you can see, last Friday, although on the earlier part of the day, we saw a very big spike up on the Dow Jones Index, but then the spike up in the early part of trading day on Friday did not manage to cross above the red color line here, which is the 200 days moving average. So they're more or less telling us that the candles that we saw for the last week is still below the 200 days MA, which means this is the longer term kind of reading health indicator. So on the longer term side, we are still unable to break above the 200 days moving average, thereby is still not looking very positive on the Dow Jones Index. And you can see also the MACD indicator, both the MACD line and the signal line are sort of maybe diverging away from each other and trajectorying downwards. So meaning that there might still be a lot of downwards pressure to come for the Dow Jones Index. And the RSI, the latest reading on Friday is about 30-point mark, which is right on the dot of where the oversold trigger is. So if let's say it goes below 30, investors will start to look at whether there will be a rebound or an oversold kind of an indicator being triggered, and then we see a bounce from there onwards. So we are still looking for some kind of confirmation. Of course, there will also be big movement coming on Friday non-farm payroll data. So I just want to take reference from the previous time where we touched about the 30-point level. That is somewhere during the March period of this year where we saw the RSI actually went to a low about 30.42. And then you can see that from the March low, we actually has a very nice rally of about 6 months up. So this is something of maybe a similar scenario. Of course, the RSI is at about the same level as what we observed in March already. So we want to wait for the MACD indicator, the MACD line, to cross above the signal line to give us a confirmation that, okay, we are on a firmer footing and then we are on an uptrend back again. So with two indicators confirming each other, we have a higher chance of success to play the uptrend upwards. So I'm still saying that, okay, we need to be a bit more patient, at least until we have more clarity on this Friday and see how the indicators perform to give us the confirmation. Okay, next, the S&P 500. The S&P 500 is slightly positive, more positive than the Dow Jones Index because it managed to stay above the 200 days moving average, the red line over here. So thereby, it is still on track for the longer term uptrend where you see this green line connecting the low of October and March this year. So this uptrend is still intact and we are still above the 200 days moving average. So that's a good sign. And on the MACD indicator, you can see that the last two trading sessions, the MACD histogram is actually showing signs that the downtrend momentum is actually subsiding. And we have a bit of a convergence of the MACD line towards the signal line. So thereby it's telling us that we are seeing the downtrend that we observed since the July period. The downtrend momentum is actually starting to subside already. On the RSI, the latest reading on Friday was 34 points, and on Wednesday, we have the lowest reading at 30.50. So this is a good sign that we have bounced up on the 30-point mark and now reading at 34. So I think that this might be even though it's still showing that there is a negative momentum, although the momentum is subsiding, we may see that this becomes a consolidation period for the S&P 500 index. And if we continue to hold above the 200 days moving average, then I'm confident the S&P 500 may actually carry on the uptrend that we observe for the longer period kind of a time frame. Okay, so the RSI at 34 now is actually at a sort of, I would say, have rebounded from the low or triggered the oversold mark at the 30-point reading on Wednesday. So thereby, I am sort of more positive on the S&P 500 moving upwards first, taking the lead and then following by the Dow Jones Index. Okay, so next, let's move to the Nasdaq Composite Index, which we have all the tech-heavy names. So the bounce that we saw on a 200-day moving average is more prominent here on the Nasdaq Composite, which is the tech-heavy index. And that means that probably the Magnificent Seven, the 7 big tech companies, probably is taking the lead on the rebound, and that the sell down that we saw since July has probably have a near-term bottom already. And we are taking reference from the Nasdaq Composite Index previous low of 18th of August, somewhere around the 13,180 points level. And the closing of Nasdaq at 13,219 points last Friday is actually above this 18 August low. So that means that we may have a possible double bottom kind of formation around here, and thereby it provides a firmer footing for the Nasdaq Composite to go higher. And this coincides with the longer-term uptrend line connecting the low in December and March as well, will provide further upside for the Nasdaq Composite Index should we have a very positive kind of data on Friday. So the MACD, you can see that it's much more prominent, the converging of the MACD line towards the signal line, thereby telling us that the negative momentum we observe in the Nasdaq Composite Index has subsided more substantially than the S&P 500 and the Dow Jones Index. So thereby, the Nasdaq Composite Index is on a much firmer footing compared to the other two US indices. The RSI is now reading at 38, so I think it's a healthy bounce from the low that we observed on Wednesday, 27 September, at the reading of 32. So this is where I think investors are starting to get back in or starting to start to accumulate on the Nasdaq Composite Index as well, because that is what the indicators are telling us, the observations. So Nasdaq Composite Index is actually on a firmer footing above the 13,200 points level. And if there is no further bad news coming out from the US economic front, as well as going into the earnings seasons, it looks pretty positive that the tech stocks might be doing well and provide a further push to the Nasdaq Composite Index. So that is my thoughts on the charts for this week. Anything that you'd like to share on, Gerald?
So basically the conclusion is look out for the Magnificent Seven, look out for S&P 500, whether it has reached a bottom, and also the non-farm payroll data that is coming out this week.
Yes, so we will track along those lines, which will help us in guiding us towards where the market is going.
Okay, so we'll probably provide an update again next week as to how these indicators are actually tracking.
Okay, if there is no further points, we would like to caution everyone to trade safely. Look out for the non-farm payroll data, which will have a lot of volatility in the market, will cause a lot of volatility. And we will see you again next week in our next weekly market review.
Thank you.
Thank you.